When you buy a home, the traditional advice is to put down 20% in cash. If you don't have $100,000 sitting in the bank when signing the paperwork, lenders will still give you a mortgage, but they apply a mandatory surcharge known as private mortgage insurance, or PMI. That fee often adds around $400 to your bill every single month. It doesn't build your home equity, and it won't buy you a new house if yours burns down. It provides zero financial benefit to the buyer, functioning strictly as a recurring penalty to protect the bank in case you default. To understand why a $400 monthly penalty is so severe, we have to look at how the Federal Reserve measures the fragility of American households. This chart visualizes their annual economic survey. Roughly 42% of American adults lack liquid savings to cover a $400 emergency. To bridge that sudden deficit, half must carry a credit card balance, pawn belongings, or use payday loans just to stay afloat. Policymakers treat a one-time $400 emergency as a stress test for financial collapse. Yet our economy extracts that same $400 as a recurring surcharge from families trying to buy a home. It operates as a systemic poverty tax. The author Terry Pratchett captured this mechanic with his Sam Vimes Boots theory of economics, explaining why lacking capital forces you to pay a premium. This graph tracks the premise. A wealthy person spends $50 on durable boots lasting 10 years. A poor person buys $10 boots. Because they break, they buy new ones annually. After a decade, they've spent twice as much. We see this exact logic in the modern American housing market. If you lack the large lump sum required for a down payment on a house, you are pushed into the rental market. Here is a comparison of household budgets. 59% of households earning under $20,000 a year spend over half their gross income on rent. By comparison, mortgaged households allocate just 12%. When rent consumes half a paycheck, accumulating the capital for a down payment becomes mathematically impossible. Exorbitant rent acts as a private tax that actively consumes wealth, locking people into permanent tenancy, where the penalty for falling behind is eviction. The extraction accelerates at the retail bank. If your balance drops too low in a mainstream checking account, you trigger monthly maintenance charges and severe overdraft fees. Because they cannot afford these recurring penalties, millions of Americans are pushed out of the traditional banking system entirely, rendering them unbanked. To access their own wages, unbanked workers must rely on alternative storefronts. A check cashing business extracts between 1% and 5% of a paycheck's face value, charging a toll just to turn paper into usable cash. This visual scales out the true cost of managing money. Low-income households spend 7.1% of their annual income, about $1,750, on basic financial services. High earners pay just 0.2%. When borrowing is required, the penalties escalate again. Buyers with subprime credit face interest rates up to 25% on auto loans, while short-term payday lenders legally charge up to 400% in interest. The financial sector has successfully monetized a lack of capital. Lenders turn the working poor into one of their most reliable demographics for profit, specifically because those borrowers have no cheaper options. This two-tiered extraction is baked into civil society. In 42 states, the justice system charges indigent defendants recoupment fees for utilizing a public defender, billing them for a constitutional right they were too poor to afford in the first place. This map shows how the auto insurance industry operates. Drivers residing in lower-income zip codes are routinely charged roughly 30% more for coverage, entirely independent of their actual driving records. We see it in grocery stores, where shoppers who cannot afford the upfront cost of buying staples in bulk pay drastically higher unit prices for the exact same calories. Which brings us back to that $400 private mortgage insurance payment. It is the cost of admission to a financial system that ruthlessly penalizes the absence of liquid wealth. Poverty operates as a state of structural vulnerability. From check cashers to rent traps to auto insurance, these compounding fees ensure the wealth gap continues to widen. The system is not broken because it charges you for lacking capital. It is functioning exactly as it was designed to.